And now for something completely different.
Forget everything you've been told by others before. Get ready for the real deal, the full story. Real talk about money, markets, life. Now, it's The Real Investment Show with Lance Roberts, presented by RIA Advisors.
And good morning, welcome to the show. Is of course Tuesday as we get this last couple of days of April. Let's just get it over with, right? I mean, it has been a tough month all around the board. No doubt about it. So we've got a lot of stuff to get into this morning. Of course, the secret conclave of popes are getting together, or actually priests are getting together to nominate the next pope. Apparently, Father John has thrown his hat into the ring. John Penn, of course. That's what we're talking about here. He threw his hat in the ring, said I would do this, and then they said, you have to, do a vow of poverty. He says, never mind. So,
wow. I love it.
He's a good Catholic boy. So, but seriously, got a lot of stuff to talk about today. Okay, so we'll get into the markets in a minute. Markets are doing fine here at the moment. Got some very positive kind of things that are going on within the markets in terms of market momentum, breadth, those type of things. But there's still a lot of concerns, right? I mean, it's the tariffs, what's going on within kind of the overall economy. The economy is slowing down. And so I'm getting a lot of emails here lately about, but the market's doing this, but, right? And there's all these buts. And those are valid points, right? Look, there's certainly issues with the tariffs. Those are going to impact the economy. We've got the port issues going on right now. Very sharp drop in shipments coming into ports, which is going to basically provide a lack of supply, right? And immediately when you start talking about that, everybody gets the flashback to 2020, where the markets collapsed, 35% in 3 weeks when we shut down the economy and said, well, not only can you not shop or do anything, you can't go outside, except to Home Depot or Lowe's or wherever else people were crowding up to buy stuff, but there's no supply. And so we're going to send you a check. And so we're going to send you money to spend and there's going to be no supply, and that's going to create this inflation. Well, a lot of people have that same concern right now, that we're going to have the same type of inflationary spike from the port shutdown. Calm down. We've had port shutdowns before. We've had port strikes. We've had all kinds of other things, and it didn't lead to a massive inflationary spike because we didn't send people checks, right? People don't have any extra money to spend right now, so it doesn't matter if there's a lack of supply at this moment. Maybe there'll be some items that you'll want to buy that are going to go up in price that maybe you were buying before that are coming in from China, but you have a choice, either not to buy them or to buy something else. And this is one thing we always talk about, a substitution effect, is that people have the ability to buy or change what they buy or what they consume. So this impact to incoming goods is going to have an impact on the economy. We are going to see a slower economic growth rate because consumers are going to contract spending. And that's just what's coming down the pike. And we already see that in the data. We're seeing that in new orders that are being placed, et cetera. And I remember just a couple of months ago, we were talking about this big surge in orders, right? We had these big surges in orders to get ahead of tariffs. Well, now you've got this impact of the problem at the ports as an example, where you've got less supply coming in, but already most of these companies have already stocked up on inventories. They were pre-ordering to get ahead of these tariffs. So the impact of the port shutdown is not going to be as dramatic as everybody's trying to make it out to be. Look, there's always a reason, there's always things that we can come up with that are super negative. It's like, if this happens, this is going to just, wreck the economy. And it's certainly going to have don't take me wrong. I'm not saying that it's going to have zero impact. I'm not saying that at all. It is going to slow the economy. Right now, we're looking at economic growth this year of somewhere around 0.5% for the entire year if tariffs remain where they are. So this is down. Now that will be down from 2.5% last year. So you're talking about substantially weaker economic growth this year. That's going to impact CEO confidence. That's going to impact CapEx spending. That's going to impact employment, right? If I'm getting 0.5% economic growth, I'm not going to be hiring a lot of people. So that's going to weigh on employment. If employment starts to weaken, as we're going to see on Friday potentially when we see the employment report, that's going to cause the Fed to start cutting rates. So you've got a lot of impacts here that certainly suggest the economy is going to slow down. That's going to impact earnings. earnings are going to have to revise down, which is going to impact valuations, which is why we've been talking about this market may be just stuck here for a while. We could very well see a period of time, kind of like in 2015, 2016, when we were going through the whole Euro crisis situation, where markets and Brexit, and everything was all kind of messed up. And we just spent several months just kind of going sideways and not really doing a whole lot. And we just kind of, we down 20%, rallied, down back to the lows, rallied again, finally got things straightened out. But it could be that kind of a year where we just simply have a lot of volatility and we don't really go anywhere. So now, here's what you need to know before the bell this morning. Markets rallied very nicely. Well, markets sold off. Let me back that up. Markets sold off yesterday morning. So we came out of the gates, markets sold off. But about mid-morning, buyers came back into the markets, and we saw the markets kind of rally all the way back to break even yesterday. And again, where we are right now is just really stuck. We've got this previous set of bottoms, and now we're kind of pushing up against that previous set of bottoms that we had. This was before the tariff announcement. Markets were kind of in line here, expecting 10% tariffs. That was going to be okay. Wasn't expecting the tariff announcement that occurred. Well, we've now regained all of that, and we're back to now retesting these lows. So that overhead resistance is certainly going to be the first tough kind of battle for the markets. Markets wrestled with it yesterday, held on to it, but again, we haven't broken above that just yet. We're still on buy signals across the board, but we are getting overbought here on a real short-term basis. So again, this was in last weekend's newsletter as well. When you take a look across markets and sectors, everything is now rallied back. We're seeing breadth improve, which is good from very, very low levels. That type of improvement in overall market breadth. And again, we're talking in today's daily market commentary, we talk about the Zeig breadth thrust, and that there's been this burst of breadth within the market that typically marks market lows. Now, it doesn't mean that the final low of the market is in, and it doesn't mean that the markets just go ripping off to a brand new high, but it suggests that most likely we've seen the lows of the markets here near term, and we've seen buyers coming back into the markets here. But it does not mean that we are out of the woods just yet. And with markets very overbought here, this is a place, as we've talked about before, and I've been getting a lot of emails from people like, oh, this market's been really rough on me, etc. This is the point, as we've been talking about, start taking profits. If you haven't lifted profits yet out of your portfolio, rebalanced your risk. Remember, we talked about neighborhoods and addresses. And again, we get to this, you look at this 50-day moving average and I go, well, as soon as I get to the 50-day, that's where I'll sell. Or I'll get to the 200-day moving average. That's where I'll sell. Okay, that's fine, but that's an address. And again, markets may not get there, but you're in the neighborhood right now of where you want to be. So please start looking at your portfolio saying, where is it that I took too much risk? Rebalance that risk in your portfolio, reallocate your portfolio as needed, raise some cash, add some defensive positions if needed, but lower that overall beta volatility of the markets to the market, because again, with us being on a buy signal here, there's a very good probability that we're going to retest probably 5,200 at least on the markets before this is all said and done. And we may spend several months here through the summer just kind of bouncing up and down. And it's going to be very trying mentally. It's going to be challenging for portfolios. Again, this is why over the last, on Friday, we increased our short position in the markets. We may do that a little bit more here if we get a little bit more of a rally today, tomorrow, whenever. But we're going to continue to be defensive here for the next couple of months until the markets start to give us a better sign that we're out of this process. And again, when you take a look at things like the Zeig breadth thrust, that typically portends to much higher market returns in 12 months, but not over the course of the next 3 to 4 to 5 months. It could still be very, very choppy in here. So again, we'll get through this, but you've got to survive this battle here near term. So take this opportunity, use this market here, start managing that risk component of your portfolio, and you'll be fine. That's what you need to know before the bell this morning. We'll come back, pick up with Father John. Don't go away.
Get daily investment news you can use, delivered at the speed of the internet at realinvestmentadvice.com.
Our next edition of Candid Coffee features special guest RIA Portfolio Manager Michael Leibowitz for an insightful look at the bond market, interest rates, and the outlook for your money. Saturday, May 3rd. It's an open chat edition of Candid Coffee with Michael Leibowitz and Richard Rosso. Register today at realinvestmentadvice.com and submit your questions for Michael and Rich. Candid Coffee with Leibowitz and Rosso. Saturday, May 3rd at realinvestmentadvice.com.
RIA Advisors Research is the envy of the industry. Our economic insights are featured on advisorperspectives.com, Fox Business, and MarketWatch. RIA provides advisors with marketing and back office support, objective research, and holistic, cutting-edge financial planning tools to meet your clients' needs. Want to join a winning team and be part of a fiduciary culture where you can do your best work? Then why haven't you contacted us yet? Go to our confidential advisor hub at realinvestmentadvice.com. RIA Advisors. Big enough where it matters, agile enough when it counts.
The Real Investment Show.
Attention Chevron employees and anyone else receiving or considering a company severance package. We know the process can be intimidating. What should you know to maximize your payout? Lump sum or pension annuity, retirement plan rollover or not? What about tax timing your severance? The fiduciary advisors at RIA Advisors can help you make the best decisions for your situation. Call us today at 855-742-7526. That's 855-742-PLAN or online at realinvestmentadvice.com.
And now, another page from the Real Investment Advisors Investing Manifesto. A passive investment portfolio requires active risk management. It's not a choice, it's necessity. Diversification doesn't protect against risk of loss. Let us actively help you reach your financial goals with RIA Advisors. Neither bull nor bear. RIA Advisors, 281-501-1791 or online at realinvestmentadvice.com.
You're listening to The Real Investment Show.
And good morning. Welcome back to the show. Of course, it is Tuesday. John Penn, good morning, sir.
Good
How are
morning.
you?
I'm good. How are you?
So you were good till you got to the vow of poverty part, huh?
I did. At least
Yeah.
I should have made my coffee with holy water this morning, apparently. I don't know.
So a couple of things to, I had a comment. I'm just going to let it go.
It's like I noticed the silence. I was like, okay, now what?
That was my brain going. It's normally I get accused of having no filter because I say just about anything that comes to my brain. But there's sometimes where my brain says, "You're on radio. Don't say that."
So what kind of show are we going to have this morning, Lance?
So all right, I'll be good. So lots of conversations lately around kind of markets and the volatility and again, there's this ongoing advice from the advisor community in general, which you sit down and talk to your advisor and it's like, hey, I'm really worried about my portfolio and a lot of volatility. It's like, just stay the course. It's fine. Buy and hold. It'll work out over time. And we went through. I showed you yesterday the problem with buy and hold is that. The issue with buy and hold is that just recovering from big drawdowns doesn't give you average rates of return like as promoters. Like, the market returns an average of 7% a year. Well, markets don't actually compound. That's one of the other kind of fallacies that you'll hear from the financial advisory community is like, markets compound over time. No, they don't. Because whenever you lose money, you destroy the power of compounding. You have to make money every single year to compound returns. So down years in markets have very big impacts, which is why we're so focused on mitigating that risk. It doesn't mean you can avoid downturns. Doesn't mean that you can avoid, the decline in the markets, but you can mitigate a lot of that risk over time to help you provide better performance. And so the problem with the static kind of buy and hold, theory, it sounds great on the surface. And as long as markets are trending higher, buy and hold is easy. But when you get into a year like this year, or you get into a year like 2020, or you get into a year like 2022, that challenge, that psychological challenge of just riding out the storm becomes very challenging, and this is where investors start to make a whole lot of mistakes. And the other problem with the buy and hold is that people don't realize in rising markets how much risk that they've taken on. They start to add in leveraged ETFs or very aggressive positions. ARK, Kathy Wood's ARK fund. I'm just going to buy and hold. It doesn't matter. Remember, we saw this with GameStop. Got diamond hands, just going to hold it, and it's going to go to the moon someday. And that works fine until the amount of risk you've taken is revealed by the market downturn. And I got an email question this morning. We spent a lot of time yesterday talking about risk management. Got an email this morning. It's like, I don't understand what risk is. Well, there's your first problem. If you're investing your money and you don't understand how to evaluate the risk you're taking, that's a real problem, because it's kind of like driving a car with your eyes closed. And you don't realize how much trouble you're going to get into until you get into trouble, and it's going to be bad. And so this is really where you've got to start thinking about, are you qualified to manage your own money?
Yeah, I mean, excuse me. I think as of late, with some of the folks that I'm visiting with that maybe aren't clients, but just kind of talking with the population out there, and that is a common concern where it's like, hey, John, I'm the one. I feel like I'm always the one, reaching out to my advisor to say, hey, what are we doing? What are our thoughts here? And the responses have been, well, we're going to stay the course, we're going to hold, and I think it's causing a little bit of friction out there between clients and maybe some of their existing advisors. And look, there's many different ways to manage risk and manage portfolios, but it seems that that's been a real underlying thread of frustration as of late, where it's I think folks are, in times like this, they're concerned about the math of loss, right? And having to dig out of a hole, because if your portfolio has a retracement, not the market here, I'm talking about your portfolio. If your portfolio has a retracement of 20%, you don't have to make 20% to get back to break even. You have to make 25.
Right.
If you're down 30%, you don't have to make 30% to get back to break even. You have to make about 43%. If you're down 50%, you got to double it.
Right.
You got to make 100 to get back to break even. So I think in times like this where markets are really volatile, to your point, Lance, it really helps people focus in on, okay, what is my risk tolerance here? How much market volatility can I withstand? And I think the message of, well, we'll just hold, we'll stay the course, markets always come back. I think for folks who are, nearing retirement, maybe you're 3 to 5, even 7 years away from retirement, or you're in those retirement years, not that you're out of equities. I mean, I can build an argument that it makes sense for you to have some exposure to equities in your portfolio, because that quote unquote retirement period, whether if it's, you just stopped working cold turkey, or are you consulting? Do you have part-time income? Whatever that might be. I mean, that could be 20, 30, for some of you, 35 years.
Yeah, and the equities provide the inflation adjustment. Yeah.
And you need to have some part of your portfolio working to help you, fight your purchasing power, fight inflation, live the quality of life that you want to live, so you can participate with the markets. But at the same time, if markets do have a more egregious pullback, you just don't want to get derailed.
Right.
Right.
And that's. But again, this is where it kind of comes back to, again, we spent a lot of time yesterday talking about risk management. If you missed the show yesterday, go to the YouTube channel, watch yesterday's show. But also I posted an article yesterday morning about risk management. And this past weekend's newsletter is talking about being like Spock, being unemotional when it comes to investing. And, so again, there's a lot of information that we produce there to help you manage and navigate your own portfolio. So again, you just go to Substack at Lance Roberts, go to our website, realinvestmentadvice.com, daily blogs, daily commentaries, newsletters, daily videos. It's a lot of stuff. It's kind of funny because we produce all this stuff and then clients go, it's too much. I can't read it. Yeah. So too much, too little, whichever one you want. But again, these are the challenges that, we're going to face. And again, we don't recognize the risk until you get into a market downturn, right? And then now all of a sudden everybody's well aware of the risk that they've taken. They're becoming well aware of what's happening in their portfolios. We get a lot of emails as of late with kind of tragic stories about things that we warned about here on the show, chasing Bitcoin, chasing, some of these other, kind of more speculative assets. and they turned out very badly. And because they were buying right at the peak, and of course now they're not at the peak anymore. And this is now like, how do I get back $300,000 that I lost, right? Type thing. And you're not, right? In most cases, you're not ever going to get that money back. So part of understanding risk is, once you're in the accident, is realizing that you're in the accident and now you've got to work your way back out of it. But the first step that we have to do is like with any problem, is just to admit that I've got a problem and then resolving it. Again, and this is kind of next Monday's article, we're going to talk about anchoring, which is one of the big problems that we have as investors, is that we get stuck on, well, my portfolio was, 500,000 and now it's 200,000. How do I get back to 500? You're not. Just that $500,000 is no longer there. Your value is whatever your value is today. That's it. And you've got to start working from the value today to get back to where you ultimately want to be on goal. And so again, this is why it's really important. And John, does this a lot with clients, sit down and build out financial plans. And so when we go through these market downturns like this, and you get worried about your portfolio value, et cetera, you can look at your plan and say, yeah, but I'm still on track. I'm still okay. Yeah. Nothing's changed. I've had a little bit of variability in the value of my portfolio. My portfolio was, $1 million, and now it's $980,000, whatever it is. And it hasn't changed my outcome. But see, without that financial plan, John, that's where it becomes really problematic, because we really don't know where we are. We're just kind of swimming in the dark.
It's like, you're investing this money, right? So your hard-earned money that you're out there working really hard for. And my question is, well, for what? Well, I need to get returns. Okay, well, what's the goal? What do you need this money to do? Right. What does that support for you look like? Right? And then let's look at the bigger picture here, because I think as investors we get so wrapped around, was it better to buy Apple, or is it better to buy Microsoft, or I got to take some profits here? What about Nvidia? And we get, these long duration bonds, look at yields. Okay, that's all very important. I get it. But there's a much bigger picture that we all need to focus on, and that is, okay, well, what's the goal for all these assets? What are your spending needs? And once we have these plans built, and like the investment approach here, Lance, that you and Michael take, where the investment approach is very fluid. Our approach to investing is not static. We are proactive. It's the same thing with plans. The plan cannot be, it's like, well, I build this and, hey, Lance, here's your plan, and then we never address it again. It's got to be this living, breathing document, this platform, because your lives are going to change moving forward, right? So, and we can stress it for situations just like this. So we can maybe talk a little bit about that when we get back.
We can talk about stress. I've got a lot of stress.
Oh, I'm stressed. Is that Kramer? Oh, I'm stressed. No,
I thought you meant Jim Cramer.
No, not Jim Cramer. Cosmo.
All right. Be back with Father John right after the break. Don't go away.
Investment Advice blog. It's required reading for the informed investor. Catch it today at realinvestmentadvice.com.
Our next edition of Candid Coffee features special guest RIA Portfolio Manager Michael Leibowitz for an insightful look at the bond market, interest rates, and the outlook for your money. Saturday, May 3rd. It's an open chat edition of Candid Coffee with Michael Leibowitz and Richard Rosso. Register today at realinvestmentadvice.com and submit your questions for Michael and Rich. Candid Coffee with Leibowitz and Rosso. Saturday, May 3rd at realinvestmentadvice.com.
Are you a financial advisor sneaking peeks at our stuff? Instead of trying to do it all yourself, why not just join the team at RIA Advisors? Our full-service organization can provide you with the support, unparalleled research, and tools for managing your clients' money and honoring the fiduciary pledge of putting clients' best interest first. Don't take our word for it. Talk to the advisors that work with us. Want to come win with us? Go to our confidential advisor hub at realinvestmentadvice.com. RIA Advisors, big enough where it matters, agile enough when it counts.
The Real Investment Show.
Attention Chevron employees and anyone else receiving or considering a company severance package. We know the process can be intimidating. What should you know to maximize your payout? Lump sum or pension annuity, retirement plan rollover or not? What about tax timing your severance? The fiduciary advisors at RIA Advisors can help you make the best decisions for your situation. Call us today at 855-742-7526. That's 855-742-PLAN. Or online at realinvestmentadvice.com.
Can't catch the whole show now? Listen to our podcast later at realinvestmentadvice.com.
I've never seen so many economists and financial people become epidemiologists in my entire life, right?
It's a Christmas miracle.
I know, right? If your choice is death or listen to Lance Roberts, I'm sure I might win at least 20% of those.
Listen to the Real Investment Show podcast from your favorite service. Same show, your schedule at realinvestmentadvice.com.
And now, another page from the Real Investment Advisors Investing Manifesto. Bulls win in bull markets. Bears win in bear markets. Eagles soar above and take advantage of opportunity. Let us help you soar as you reach your financial goals with RIA Advisors. Neither bull nor bear. RIA Advisors, 281-501-1791 or online at realinvestmentadvice.com.
The Real Investment Show.
If you're working and looking to retire soon, a Medicare special enrollment period is in your future. Understanding Medicare choices, enrollment deadlines, and costs are essential to your overall standard of living in retirement. The wrong choices can cost you thousands in penalties. Make sense of Medicare's alphabet soup with RIA Advisors' online resources and one-on-one partners to help secure the healthcare insurance choice that is right for your lifestyle and budget and avoid gaps in coverage. Click on the insurance tab at realinvestmentadvice.com today. realinvestmentadvice.com.
The Real Investment Show YouTube channel has all our videos ready for your easy access. Now with the new and improved Before the Bell reports, plus each day's radio shows. Subscribe and bookmark our YouTube channel at realinvestmentadvice.com.
You're listening to The Real Investment Show.
Trying to figure out how to get there. And welcome back to the show this morning. So just real quick, John, you were just kind of finishing up talking about a point.
So we were talking a little bit about, putting plans together, focusing on the bigger picture, right? Because, like earlier this year, spoke with a lot of folks who were making some knee-jerk reactions with the market volatility. And rather than focusing on the long term, on their big picture, it was that fight or flight. Get me out. And actually, if you've had a balanced portfolio this year, you're actually weathering this volatility very well. You're probably actually positive for the year, right? Mm-hmm. So don't let the headlines just kind of beat you down. You're actually take a step back and look at what your portfolio really looks like, because chances are you might be doing better than what you think. But when we build those financial plans, Lance, when we're looking at, longer term, kind of where are you? Where do you want to go? Let's look at all your sources of income, Social Security, annuities, pension, deferred comp, all of this that we wrap into a plan. A lot of the common questions I'm getting is, okay, well, what happens if markets do drop, John, by 20%? What happens if my Social Security benefit is reduced? What happens if inflation ticks higher by 1% or 1.5%? What if I live longer? What if there's extra longevity in my family? How does this all affect kind of this long-term outcome of the plan? So, we can really throw a lot at the plan to say, okay, well, Mr. or Mrs. Client, if this happens, this is how this looks. If this happens, this is how this looks. And hey, if this outcome doesn't look so hot, let's start doing some things now to get you better prepared in case this would happen, right? So again, we want to get higher above. While the stocks and bonds and the allocation is extremely important, we want to look at this bigger picture and kind of get up above the trees and look at the forest, right?
Well, and it's also too when when you or Richard or Danny are running these plans.
Yeah.
y'all can plug these into these plans and say, look, let's assume that next year, your first year in retirement, there's a 20% drawdown in the market. Let's see how that affects your plan.
Right.
It doesn't. And once you start kind of stress testing these plans like you're talking about and putting these different events in, and look, give me your worst case scenarios, plug them all in, and see how you do. Yeah. And at least then you have a better picture. Like, okay, this is what I can expect, because we can always make choices, as we all know. It's interesting right now. As a good example, Warren Buffett's carrying $300 billion in cash, and everybody's like, "Oh my gosh, he's carrying so much cash because he's expecting this huge market downturn." No, actually, he's not. He's just saying two things, and he has said this directly: is that he said, "Look, right now there's just nothing I want to buy, so I've got cash, and if there is a market event, I want cash to buy things really cheap, like I did in 2008. He cut 10% preferred deals with Goldman Sachs and made a killing off that." Liquidity gives you options. It doesn't necessarily mean that you're expecting the markets to completely fall apart. Everybody's like, well, he sold Apple. It's like, he sold some of his Apple position because it was a huge stake that he owned. He took profits in it, just as we talk about here all the time, is he took profits, reduced his risk, and raised some cash. And he can come back and buy more Apple at some point if he thinks it gets cheap enough, right? So again, you have to not extrapolate just because Warren Buffett's doing one thing. He still has the majority of his money in equities, the vast majority of his money in equity. His market cap's over $1 trillion. So, when you look at, how his funds are allocated, it's mostly in equities. And he's got a lot of money tied up in big companies that he owns. But, this is why it's important to keep some perspective about how you're investing and the risk you're taking. And again, I see a lot of these articles, and these are the worst articles ever to come out. And they're great feeders for clicks and all this type of stuff. It's like, did you realize if you'd bought NVIDIA at, the October 2022 lows, you would be up, 1,000% or whatever it is since then? Great. Hindsight is great. It's like, I wish I could have done it. If I would have bought puts at exactly the market peak this year and sold them exactly at the market bottom, I would have made 100 times on my money. Sure, that's great, useless piece of information. Because at the moment, we're dealing with the markets at this moment, and we're trying to make bets about the future. And so you've got to make reasonable, rational bets about how you invest your capital and when you invest it and when risk outweighs reward. And look, this is why we're carrying extra cash right now. We've got a short positional portfolio because risk outweighs reward at the moment. But we're not entirely out of equities. And this is why, our portfolios have held up very, very well this year. I'm expecting them to continue to hold up well this year. A good example, bonds went from being up 7% in February down 14% in early April, and now they're up 3% for the year. So, they've had a huge swing in performance just in the matter of a couple of months. If you'd bought the exact dip in bonds, you've been great, right? But this is why you just have to navigate this volatility without making big mistakes.
Yeah, so when we were talking about, Warren, he also made the quote. So he's holding that, that cash right now, but he also mentions, he says that Berkshire will never prefer ownership of cash equivalent assets over the ownership of good businesses, whether controlled or partially owned. So, he likes having his money positioned for growth in things that he understands and that makes sense. But there's also times where he's going to hold more cash because he's taken some profits or he's waiting for some opportunities. We've got cash in the portfolio here for that very reason.
And again, I said that, and of course, immediately in the chat, nothing I want to buy. It sounds like he's waiting for a big downturn to come to me. And no, that's not. It's just that you have to understand he is a $1 trillion business. There's lots of small companies out there that he could buy that are reasonably cheap, but he can't buy them because they're very small companies. He has to buy companies like Occidental Petroleum. He has to buy big, major corporations that will move the needle. And right now, those big, major corporations that are out there, either A, they're not available for sale, or B, they are temporarily overvalued, and they're not in a position to where he would want to own that company on a deep valuation basis, because he's a deep value fundamental buyer. And valuations are expensive in the markets, no doubt about that. But it doesn't mean that tomorrow he won't announce, if he finds an opportunity, that he won't announce, hey, I'm going to spend, $10 billion and I'm going to buy this company. But it's going to have to be a big purchase for him because he's so large now. That's been a big problem for Warren Buffett over the last really 20 years. He's gotten so large that his ability to be nimble and buy companies like See's Candy or a Geico when he bought Geico way back when, there was a very much smaller company. Those opportunities are not available to him anymore because of the amount of capital he has to deploy at one time. It's got to move the needle.
Yeah. So earlier in the show, you were talking a little bit about investors out there kind of looking for a narrative, looking for a reason, right? Looking maybe for a reason not to invest. I hear constantly, well, I want to get through the election. Oh, we're coming up on a government shutdown, whatever it is. There's
always something.
The narrative of the day. And so now,
port strike.
What's that? Yeah, port strike, whatever it is, right? And over the last, I would say probably over the last week or two, emotions overall, I think, have calmed down a little bit because we've seen some strength to the market. But folks are now, well, what's next? What's next? What the Fed going to do? How will the market react to that? Or, there's always this narrative out there. So earlier we were talking a little bit about, hey, markets have had some strength here, but maybe we're not out of the woods just yet. Maybe we still have some volatility this year. Who knows? Is this a market environment where we just have a little bit of ping pong and back and forth this year? Is that a reason not to invest?
Right.
Right?
Mm-hmm. Oh, you want me to answer that question?
Yeah.
No, of course it's not a reason not to invest.
It's like,
I was letting you run with the point. I
Well,
was waiting for Father John to enlighten me.
Well, if we're in session, well, let's go in there and have some confession time. All right, let's do it.
I need 6 Hail Marys and a. I'm not Catholic, so you have to help me through that part.
No, I'm not either. So, yeah. Sorry to burst your bubble on that one.
You just ruined your whole mystique. I was trying to give you your own nickname here for the show. We've got Danny Bulldog Ratliff. We needed a nickname for Father John. Now you've ruined it.
Well,
you're exposed. You're not Catholic.
Sorry, I'm not Catholic. I'm sorry about that. But if you still want to call me Father John, that's fine. Right. Trust me, I've been called a lot worse.
That's true. Rabbi John. That's it.
All right. Probably not close on that one either. Nope. Keep trying.
Anyway. So, there's always reasons not to invest.
Yeah.
There's plenty of reasons not to invest. And the problem with not investing is that you miss the reasons to invest.
Yeah.
Which is to grow our capital and to make sure it's outpacing inflation and make sure that we're maintaining purchasing power of our savings. But the problem is that individuals then take it too far in the other direction and they start trying to get rich quick by being in the markets. And that sounds great. I can get rich quick in the markets. I can buy a lot of speculative assets. I can take on a lot of risk. I can do all these, I can do options. I can do all this other stuff. And it may work for a bit. But I've been in this business for coming up on 40 years now. It's like 37 years. And I have never seen traders last more than 2 or 3 years. And they blow up. And this has been consistent over in the late 90s. I saw traders that were killing it in the late 90s. They were all gone by 2002. But that happens in markets. And it's okay to try to trade markets and try to be smarter than the market, but the market is the house in terms of Las Vegas, and the house always wins eventually. So just be careful with the risk you're taking. All right, we'll come back. We'll talk a little bit about leverage when we come back from the break. Don't go away.
Get daily investment news you can use, delivered at the speed of the internet at realinvestmentadvice.com.
Our next edition of Candid Coffee features special guest RIA Portfolio Manager Michael Leibowitz for an insightful look at the bond market, interest rates, and the outlook for your money. Saturday, May 3rd. It's an open chat edition of Candid Coffee with Michael Leibowitz and Richard Rosso. Register today at realinvestmentadvice.com and submit your questions for Michael and Rich. Candid Coffee with Leibowitz and Rosso. Saturday, May 3rd at realinvestmentadvice.com.
Attention Chevron employees and anyone else receiving or considering a company severance package. We know the process can be intimidating. What should you know to maximize your payout? Lump sum or pension annuity, retirement plan rollover or not? What about tax timing your severance? The fiduciary advisors at RIA Advisors can help you make the best decisions for your situation. Call us today at 855-742-7526. That's 855-742-PLAN. Or online at realinvestmentadvice.com.
The Real Investment Show.
RIA Advisors Research is the envy of the industry. Our economic insights are featured on advisorperspectives.com, Fox Business, and MarketWatch. RIA provides advisors with marketing and back office support, objective research, and holistic, cutting-edge financial planning tools to meet your clients' needs. Want to join a winning team and be part of a fiduciary culture where you can do your best work? Then why haven't you contacted us yet? Go to our confidential advisor hub at realinvestmentadvice.com. RIA Advisors. Big enough where it matters, agile enough when it counts.
And now, another page from the Real Investment Advisors Investing Manifesto. Manage risk and volatility rather than trying to manage gains. You don't have to be right all the time. Long-term investing success is a 70% gain. Let us help you reach your financial goals with RIA Advisors. Neither bull nor bear. RIA Advisors, 281-501-1791 or online at realinvestmentadvice.com.
You're listening to The Real Investment Show.
I just saw a commercial on, we have a bunch of TVs in our studio, so I can keep up with the news of what's going on, markets, etc. And there was a commercial up about Zip Intro, which is a new online kind of job application. You can build your own profile, and it's like Tinder for jobs, right? So, and this has been a new thing. Well, just reminded me is like there's a new crisis now for corporations to deal with, and part of their problem right now is that they're getting a lot of job applicants that are coming in that are all AI generated. They're not actually real people, and people are posting these AI job they're applying to jobs with fake job postings, and companies are now having to figure out how to interview people in person again. So, part of one of the drawbacks of all this remote office work is like, oh, you could just interview people online and all this. So now with these AI deep fakes and all this other stuff, like they can have online interviews with people and it's all AI generated on the other side. And they're having to come up with technology now to try to, figure out if people they're interviewing are actually real people or not. I'm not sure what the benefit for the other guy is on, that's creating the deep fakes. I mean, you got to show, great, I got the job. Crap, now I got to show up to work.
Yeah, I actually got to prove that I know what I can interview, what I can do, what I said I can do.
I'm not sure what that guy gets out of it, but this is a new challenge for corporate HR. And there was actually an interview this morning on the radio talking about, they interviewed the CEO. It's like, yeah, we had to hire a whole person that's super experienced in AI just to vet out real applicants versus non-real applicants. So,
I remember, good old days. I was back when the stone chisel was in place, sending out my resume and cover letters and mailing them to corporations.
Yep.
Right.
Remember those days?
Oh yeah. And then I can't remember how many I must have sent out. And then you get your letter back either for the next step or not or what have you. And now our youngest daughter is she'll be graduating later this year from college, and she's in that next step phase, and brushing up the resume, the cover letter, and all this stuff. And she's like, "Well, Dad, I can just have ChatGPT. I can just tell AI to form my cover letter for me." I was like, "No, we're going to sit down."
They're all scanning that now too.
Yeah, it's like we're going to sit down and we're going to craft this from you. right?
Yeah, there's actually a new thing that ChatGPT has done is they're now inserting code into whenever you ask ChatGPT to write something, it inserts this invisible code in it that other AI programs, when they scan it, they see that code and it knows that it was generated by ChatGPT. So you're not getting away with that anymore. But it is interesting because, my kids have all been raised in this technological environment for the most part. And it's so fascinating because I'll talk to them. I was like, hey, have you gone out to apply for a job yet? You got to have a job, whatever. They'll have jobs. They're all working. They're still in school. They have to work. They're required to work while they're in school. No free lunches. But it was interesting through that. It's like, well, I sent out, 15 applications. I go, did you go talk to anybody?
Yeah.
Well, no, you can't go talk to anybody. He's like, yeah, you can.
Just pick up the phone.
Pick up the phone. Go down to, like my youngest daughter was applying at a grocery store to be a cashier. And I'm like, just go down there and find the manager that's on the floor and introduce yourself.
Yeah.
And so it's like she fought me on it. And then, that job filled. And then she was applying for a waitress hostess job at a restaurant. I said, go down there and talk to the manager. And so finally she did. And she put in her application, hadn't heard anything for like a week, went down there, found the manager, introduced herself, got the job on the spot. At the end of the day, people still want to talk to people, and this is going to be a big challenge for this kind of younger generation coming up is learning how to actually communicate and talk to people.
Well, our oldest has been out of college now for 2 years. She's been in her first post-college career. She's actually moving to San Antonio later this week with transferring to a different office out there.
Nice.
Our
Congrats.
What's that?
Congrats.
Thank you. Yeah. So she's excited about it.
Awesome.
So our youngest, so we kind of did the same thing where, she, one of her jobs when she was in school was to be a hostess at a local restaurant here in Houston. And it was just reaching out and, getting the interview. Well, I've emailed. I haven't heard anything back. It's like, well, did you pick up the phone and call to make sure that they received your resume?
Yeah.
And so she got over the anxiety, picked up the phone, made the call, and they said, yes, we have your resume. We'd like to talk with you. I said, and so our youngest daughter's name is Andy. I said, Andy, all you need to do is walk in there, and with your personality, they're going to hire you on the spot. Mm-hmm. What happened? Hired her on the spot.
Yep.
Right? And the hostess role for her was so good because it forced her to communicate, not just with people, with kids, I would say, because everybody there that was working there at the restaurant, they're all about the same age. They're all young. They're all beautiful. It was like the land of the gods and goddesses. Whenever we went in there, I was like, my goodness, am I old, right?
Right.
But not only did she have that immediate community with peers of her age, it forced her to talk with, older folks and how to communicate and, conflict resolution because she was on the front line, right? Yeah.
No, look, and this has been one thing I've forced my kids to do all these years is like go up to just strangers and introduce yourself. Like I take my son into a restaurant. I walk over there and introduce yourself. So that guy's like, why? I was like, just do it. Just walk over there and introduce yourself, because I wanted to get him over that fear of talking to people. And because look, it doesn't matter what job you do. Ultimately, it's sales. And you've got to be able to either sell whatever company you work for, you're selling a product or a service, no matter what your job is. And so when a client calls up or a customer calls up and you pick up the phone, whatever it is, you've got to be able to sell whatever you're doing. And so being able to talk to people is very important. And so I forced my kids to get into that process of being able to communicate, look somebody in the eye, shake their hand well, and communicate. And it's paid off in
Absolutely.
spades. And they have this understanding. And like I've got a daughter in Austin right now. She's going to school, but she's in a job where she sells. I mean, she's on the front line selling every day, and she's killing it. And it's great, right? Because she can communicate.
Yeah.
She focuses well, those type of things. Even though she's dyslexic as hell, but she sells well. She sells people the wrong product, but
they still love
it. I'm joking. And baby, if you're listening, I love you. She knows it. She's all completely good with it. So anyway, all right, quick shift. Don't turn that into a clip.
Oh, that's gold.
No.
I think Brent's licking his chops.
Anyway, talk about leverage here real quick. I got a long email yesterday from a gentleman talking about, he just wants to pay off all of his debt, and he's selling all of his assets to all of his equities, et cetera, to pay off his house and those type of things. Leverage is not a bad thing if you use it right? You should not use leverage in your portfolio, because that's going to work out really badly at some point. That's just a function of time. But in managing your financial net worth, leverage used appropriately is a great thing. Your house is a good example. I would never pay off my house. I will never pay off my house. I will always have a mortgage on it of some sort, because it's cheap money, particularly at right now my mortgage is like 3.5%. And I can borrow from myself through my whole life insurance policy. And so I can create leverage with myself, right? The interest is tax deductible, and I have an appreciable asset that is growing. It's created, and the asset is growing in value. And I'm not having to, and I can minimize taxation through leverage. And this is why, if you ever look at really rich people, they have no aversion to debt, because they have let's say they've got $1 million stock portfolio, right? As an example. Well, I can borrow against that $1 million stock portfolio. And I'm using a really basic example, but this is why people that have a lot of publicly traded stock, like Elon Musk, et cetera, they basically have billions in loans against those assets. Elon Musk, Jeff Bezos, et cetera. They borrow against that portfolio, because when they borrow against that portfolio, if they sold that stock that they have a very cheap cost basis in, they generate huge capital gains. So they pay taxes on that money. But yes, they've got money, but now they pay tax, and they no longer have an appreciable asset. But they'll take that money, they'll borrow against it. The interest is tax deductible, and then they'll buy an appreciable asset. Now, they don't go buy more stock with it, right? They buy real estate. They buy things that have defined value that don't go down over time, but they'll buy houses, and they'll buy, real estate, farmlands, those type of things that will appreciate over time, and they can expand their wealth and have, again, their assets that are still growing on the bottom side. They're deducting the interest on the loan, and then the asset that they bought, the real estate, is growing in value as well. And that's how they build more and more wealth over time. The average person is selling stock to go buy a house, and then they pay off their house, right? So now they paid tax on the money. They've depreciated their investable asset to buy another house. All they did was swap assets they swapped a high growth asset into a low growth asset. So, and my point about this is that you should not be afraid of leverage. Just, it has to be used the right way. And speculating with leverage is a terrible idea. Investing with leverage can be very, very beneficial. Again, if you do it the right way and you understand what you're doing and you can manage that risk, it's a way to build real wealth. And that's a hard concept for a lot of people to understand, because they listen to Dave Ramsey. It's like, pay off everything. That's great if you pay off everything if you have no money. But if you've built wealth, learn how to use leverage to build more wealth the right way. All right, wraps this day. Show for the day. John, thank you so much.
You bet.
See you next time, tomorrow, right here on The Real Investment Show.